Okay, well, hello everyone and welcome to today's Orbex Trader Education session. I'm James Harte, and in today's session we're going to cover one of the most important aspects of forex technical trading, and that is the concept of confluence. So firstly, what do we mean by confluence? Well, in the context of trading, confluence is simply where we can identify two or more technical elements coinciding with each other. So that's all it is. It's just the presence of different technical elements in the same location on the charts. So why is this important? Well, if we are looking to enter the market and risk our money, we want to always make sure that we have the best possible reason for doing so and the highest chance of succeeding with our trade idea. And we can do this by identifying confluence in the marketplace. Again, by identifying the presence of different technical elements, and this increases the likelihood of our trade working. So let's start by outlining the process of how we approach the market, building a trade idea and highlighting confluence to enter a trade. And as ever, if you have any questions during the session, please just write them in the chat function and I'll stop periodically to answer them. Okay, so let's kick off then. Here we have a great example of how we can build confluence in the market. And if any of you are a bit unsure about the different things that you're seeing on the chart, don't worry, we're going to walk through them now. So let's imagine that we're at this point in time here where price is starting to retrace higher after we've seen this large bearish swing. Okay, so we've just had a really lengthy decline, and we know that the market moves in phases of trend and correction. So after this long sustained sell-off, we know that price is likely to start to correct higher. However, we assume that at some point price is going to reverse and resume the bearish trend. So we want to try and identify a good place to sell. Now, first of all, we can look for any clear structural resistance, okay? And so the first level that stands out here, you can see I've marked this in red, is this big level of prior support which was broken. So you can see that we had two solid touches at this level. This was a really important level for the market over several months. Price broke down through that support level and we continued the sell-off. However, once we get to this point here and price bottoms out and starts to retrace higher, this is an initial area which will capture our interest, and we can think, right, if price trades back up to that level, this might be an area which we can look to sell. For those of you who are in the support and resistance sessions, you should remember that broken support will often become resistance and vice versa. So we go ahead and mark in our broken support level, which is our potential resistance level. And once we have this level in place, we then want to look to try and find confluence. So we want to identify other technical elements that are present at that level also. So at this point, one classic technical element which we can look for is Fibonacci retracement levels. So we go ahead and draw in our Fibonacci retracement from the high down to the low. And you can see that this tool plots our key Fibonacci levels on the chart. And hopefully you'll notice that the 50% retracement level, which is a key Fibonacci level, lines up at the exact point of that broken support. So at this point now, we have confluence between our solid structural resistance level and also our key 50% Fibonacci retracement level. So clearly this is a level which we're going to look to try and engage the market at. Now, we can then go one step further by using an indicator to help us confirm our trade idea. So we know that we're expecting this current bullish retracement to end and for the bearish trend to resume. And so a great indicator to help us confirm this is the relative strength index. So you can see this at the bottom. This is a momentum oscillator which we can use to help us identify when momentum in the market is overstretched. So with our RSI indicator turned on, you can see something really interesting happening at the point that price tests this key level which we've marked out. So this key level which we're watching, where we have confluence between broken prior support and the 50% retracement, you can see that as price touches that level, we have clear bearish divergence showing on the RSI indicator. So let me just walk you through what this means. Essentially, if you can see how price is behaving as we correct higher, so we get this initial price high at this point, and you can see that the RSI indicator puts in a high. We then get a retracement lower, and price trades back up to put in a new high, and again you can see the RSI indicator puts in a new high, confirming that there is still further bullish momentum in the market. However, at the point that we put in our third high, as we test that key level which we're watching, you can see that the RSI indicator has actually registered a lower high. So what this says to us, what this tells us, is that bullish momentum in the market is waning, okay? So instead of buyers continuing to jump into the market in stronger form each time, what's actually happened is we've lost some buying pressure as price has tested that level, and you can see I put in that downward sloping line just to highlight that lower high. So if you think about what the market is telling us now at this level, we've highlighted a key technical level where we have a strong broken support turned resistance. We also have Confluence with the 50% retracement from the high to the low. And then to confirm our bearish trade idea, you can see that we also have identified bearish divergence on the RSI indicator, which shows us that bullish momentum is waning in the market and alerts us to the potential for a reversal. So this is a great example of where we can use different technical elements to build a case for taking a trade. So again, we've started by identifying a structural level of interest. This gives us the first place on the chart where we're potentially going to look to enter a trade. We then identify Confluence with our Fibonacci retracement level, and so we know this is definitely a level where we're going to look to engage the market. And then finally, we've used a technical indicator, the RSI, to confirm divergence in momentum at that level, which again gives us the go-ahead to enter our trade. So hopefully you can all see how we're piecing together these technical elements to build an idea. So the same way that a detective puts together evidence in a case, this is exactly what we're doing here. We're piecing together these different technical elements to strengthen our case for taking a trade at a certain level. So let's move on and take a look at another example then of how we can piece together these different technical elements to identify high probability trade setups. Okay, so in this example then, let's imagine we're at this point of time here where we can see that price is moving higher in a bullish trend. We're correcting lower. Now what we can do immediately is identify a bullish trend line here, okay? Hopefully for those of you who remember the trend line session or are familiar with trend lines, you'll know that to identify a trend line, we simply need to connect two swing points. So because this is a bullish trend line, we're looking to connect two higher swing points. So we have the low of price, and then we have a secondary low, and you can see that that gives us our bullish trend line. So once our bullish trend line is in place, what we're then looking to do is use this trend line as support. We know that price tends to respect these trend lines, finding resistance at bearish trend lines and support at bullish trend lines. So as price continues to trade higher, it's simply a case of monitoring this blue bullish trend line, waiting for a point at which price comes down to test it. Now again, we don't simply want to enter the market just based on the presence of one technical element. And so what we're looking to do is identify Confluence, identify the presence of a second technical element. And so again, we can turn to our Fibonacci retracement tool. So applying our Fibonacci retracement tool from the last swing low up to the swing high from which price started to correct lower, you can see that the 61.8% retracement comes in at that bullish trend line, okay? So this is another fantastic example of where we get confluence between two different technical elements. So this would have been a great way to enter this bullish trend. But again, for added confluence, for further confluence, we can bring in a technical indicator. So this time you can see that the indicator I've got in the bottom panel of the chart is the stochastics indicator, which is another momentum oscillator. So this is another indicator which identifies when price momentum is overstretched, signaling price as either overbought and likely to correct lower, or oversold and likely to correct higher. So looking at the stochastics indicator then, you can see that at the point that price tested the bullish trend line, tested that 61.8% Fibonacci retracement level, that the indicator was registering heavy oversold momentum in the market. So when the stochastics indicator is registering oversold momentum, this highlights the potential for a reversal higher. So once again, what we're doing is pulling together these different technical elements to increase our bias, to strengthen our case for taking a trade. So we've identified a bullish trend line, we know that price is trending higher, and we know that price tends to respect these bullish trend lines. So we're looking to take a trade as price tests the trend line. However, to improve our chances of success with the trade, we're looking to identify confluence with different technical elements. And so we've pulled in our Fibonacci retracement tool. We've identified confluence with a key Fibonacci retracement level. And then furthermore, to add extra weight to our trade idea, we've also identified an oversold momentum reading on the stochastics indicator. So hopefully by now you're starting to get the idea about how we can tie different technical elements together to establish confluence to help us identify potential trade locations. Now, the process for identifying confluence is simple, and you need to only start by identifying initial technical elements, okay? So, as I'm saying, what we want to begin with is simply one technical element which gives us an idea about where we might like to enter the market. We then look to identify confluence with other technical elements such as support and resistance, trend lines, Fibonacci retracements, technical indicators, etc., and see where they line up together. So you can then start to add indicators to the mix to help you confirm your level. Laksh asks, wouldn't the stop have been hit since it fell to the 76.4% retracement level? Well, Laksh, what you can see actually is that the first and the initial reaction sees price trading higher by over 250 pips. So depending on what your exact trade parameters were, so depending on how your stop was placed and what your target was, this could either have been a trade which you made some initial profit on or you hold for longer. And so typically where we're entering in a bullish trade like this, as we've talked about in some previous sessions, our stop would usually go below the last swing low. So in this case, our stop wouldn't have been as tight as the 76.4% retracement. But then again, this does come down to your own specific trade parameters. So depending on how you would manage a trade like this, your stop could well have been hit. However, I'd assume that that initial 200 plus pip reaction would have at least seen you move your stop to break even or take some profit. So going back to how we use Confluence then. We've looked at how we can use Confluence to identify trade setups, but we also need to think about how we can use Confluence to enter trades, okay? So far, we've been looking at how we can identify confluence, so the presence of different technical elements in the same area to give us an idea of where we'd like to enter the market. However, we can also use confluence as an actual method of execution, so to give us the green light, so to speak, on entering the trades. One of the main issues actually that a lot of traders struggle with, both old and new actually, is perfecting and refining their entry methods. Because it's one thing to highlight a level that you want to trade at. I'm sure many of you have looked at the charts, you've identified a trade location and thought, right, I think once price gets here, it's likely to reverse. But I'm sure that many of you still have difficulty in executing trades and entering your trades at the right point. And it can definitely be frustrating, and as I say, not just for new traders, but also for seasoned traders, in refining your execution methods to really capitalize on your ability to highlight these trade setups. So usually this is the case. We can see, for example, that price would be moving sharply higher into a level that we want to sell at. However, the move seems quite explosive, so the trader becomes worried that price won't reverse from their entry level and that it will just burst through. Now, although this is really an issue relating to trader psychology and the discipline in executing based along a plan, which we'll look at thoroughly in another session actually, because that's definitely an interesting subject. This is also an issue to do with how traders actually enter a trade and having defined criteria on how they enter the market. Now, in my own experience, the best way that I've found to enter a trade at a predetermined level is to wait for price action confluence. So this is where we get confluence between price action and the actual setup location. So what we're technically looking to do is identify reversal candlesticks at our chosen trade location before entering the trade. So the premise behind this approach is that if price is truly going to stall at our trade location and set up a big reversal, for example, then price is going to indicate this, or this is going to be reflected in the price action by the way the candlesticks react with our trade setup location. For example, if we're expecting to see price sell off from a resistance level, then we want to see the presence of bearish reversal candlesticks forming at that level to confirm our entry. Now, this is clearly a slightly more conservative approach to entering the market, but over time what you should find is that it helps you to catch much better trades and avoid some of the losing trades that you would take if you were simply trading blind at the level, e.g. just entering at the level of the trade setup. Because even the best trade locations don't ensure that price will do what you think, okay? And for that matter, waiting for reversal candlesticks doesn't guarantee that you'll have a winning trade each time. However, what you should find, and this is what it comes down to your own research and back testing, is that if you wait for a little extra confirmation by way of some price action confluence, you end up missing out on more of the unnecessary losers which you would have suffered if you just traded blindly at the level. So waiting for extra confirmation by way of price action confluence is a really great way to be more strategic in how you enter the market and increase your chances of success. So let's take a look at some examples then, and I'll walk you through this process. Okay, so here you can see that we have a classic double top scenario. So for those of you who were in the chart pattern session, this is a classic bearish reversal pattern where we have price stalling at a former high, forming a double top before reversing lower. Okay, so this pattern is simply identified by the presence of two big highs lining up at the same level, and it technically forms an M shape. So you might have heard or seen this pattern referred to as an M top. Now, one of the best ways to trade this pattern to increase the risk reward profile on the trade in our favor is to look to enter at the site of the second top. So we first of all have to identify our significant swing high which price reversed heavily from. So you can see that this is our clear first high in this pattern. Price rallied up sharply. We traded all the way up to this level. You can see we had a succession of mostly green bullish candles before price stalled and reversed heavily lower. So we mark our level in here, giving us our first top. We then monitor the market, waiting to see price trade back up to that level, where we expect the level will hold and form a double top from which price will sell off, where we're obviously looking to capitalize or profit on the reversal. However, to go ahead and enter a trade at this level, so once price trades back up to this first top, to enter the trade, we want to see some price action confluence. Okay, we're waiting for that extra confirmation. So we want to see the presence of bearish reversal candlesticks form at this level, such as bearish engulfing candles, bearish pin bars, or hanging man candles. Okay, we want to see the presence of bearish reversal candles which say to us that sellers have been engaged at this level. Okay, candlesticks reflect the underlying order flow in the market. So the presence of bearish reversal candles at a bearish trade setup location tells us that we are right, that our bias is correct, and we can go ahead and enter the market. So in this example, you can see that we did in fact get a really clear bearish reversal candle. You can see that this red candle here is the one I'm talking about, and this is what we call a bearish pin bar candle. So hopefully for those of you who are in the candlestick patterns session, or for those of you who are familiar with price action, you'll know that the pin bar represents an acute shift in sentiment. So in the case of a bearish pin bar, what we can see is that price opened at this point here. Buyers drove price all the way up to this high, where sellers then stepped in and drove price sharply lower, and you can see that we closed all the way off the highs down here with a small candle at the bottom, okay? A small body, rather, at the bottom of the candle. So we get this long tail, which gives the pin bar candle its name. It's shortened version of the Pinocchio candle, and this reflects to us that there's been a significant shift in sentiment in the market during the course of that session. And so this highlights to us the potential of a broader reversal. So with the presence of this candle in place, again, we need to always be thinking about what the market is telling us. So with this candle in place, knowing that we've identified an acute shift in sentiment at a potentially bearish trade location level, this gives us the go-ahead to enter our bearish trade, okay? So this candlestick is a fantastic precursor to bearish reversals. We've identified a bearish reversal pattern with our double top, and at the site of the double top where we're looking to enter our sell setup, our sell trade rather, we've identified a classic bearish reversal candle. So the confluence between this bearish reversal candle at the site of a bearish reversal pattern gives us the confirmation that we need to go ahead and enter our sell trade. And as you can see, price sold off sharply from this level. So hopefully now you're really starting to understand both the mindset and the process that you need to adopt and apply when identifying confluence in the market. So again, to use that analogy, just like a detective puts together evidence in a case, it's a question of looking at the different elements that the market is presenting to you, identifying where these elements line up, and then really thinking, what is the market telling me? What is the confluence between these different technical elements telling me? And what are these technical elements suggesting the next price move is likely to be? Okay, so in this example, we have a potential double top, but it's only the presence of the reversal candlestick that signals a reversal lower, okay? If price had simply traded up to that level and we sold the level, we'd be taking a blind guess that price is going to reverse from there. And what we're doing is exposing ourselves to unnecessary risk that price will simply continue higher. However, the presence of the bearish pin bar at that level signals to us that sellers are active, okay? That sellers are active at the level and a bearish reversal is likely to happen, or at least that price is vulnerable to a bearish reversal. So confluence is a way of helping us understand what the market is likely to do. Without the presence of any bearish reversal candlesticks at that level, we could reasonably expect that price was simply going to carry on higher and break the double top formation. Okay, so it really is the presence of these reversal candlesticks at these trade setups location, which is the missing piece of the puzzle in how we engage the market. So we need to first of all identify the presence of these different technical elements to identify a trade setup location, and then we then want to identify confluence between the trade setup location and reversal candlesticks which support our idea, and that gives us the go-ahead, the final confirmation to take our trade. So is everyone clear on that just before we move on? Great, okay. So we've now looked at how to combine different technical elements to identify confluence, and we've also looked at how we can identify confluence between trade locations and price action to give us our entry trigger for a trade. What we can now start to think about is how we can identify confluence between multiple time frames to give us an even stronger chance of succeeding with our trades. So if you were in the multi-time frame analysis session, you'll know that one of the best ways to form trade ideas in forex, to perform analysis on currency pairs, is to look through multi-time frames. So to look at the higher time frames and see what price is doing there, look to find trends, and then look to find specific trade setups on the lower time frames that line up with the higher time frames. So we're looking to identify confluence between time frames. For example, if the daily stochastics or RSI indicator are showing that momentum is oversold, then we know that we want to see a reversal higher. And so if we can drop down onto the lower time frames then and identify a period where price has moved higher and retraced lower, potentially into a key Fibonacci retracement point, this gives us an opportunity to buy, which of course is in line with the higher time frame trend. So we've identified confluence between time frames there, between different time frames, which increases our chance of success. However, we don't need to just use indicators when studying higher time frames. We can also simply assess the markets using the same sort of technical elements that we've just been looking at, such as support and resistance, trend lines, price action, price patterns, Fibonacci levels, and so on. So let's take a look at how we can build confluence between time frames. And we'll start looking at our double top pattern again. So this double top pattern actually occurred on the weekly time frame. So we've identified a strong resistance level. We then identified a strong bearish reversal candle. And so from that point, when we identify that candlestick, we're expecting that price is going to sell off and trade lower. So as price starts to move lower, we then want to drop down onto the lower time frames and find technical setups which offer us the opportunity to enter short trades in line with the higher time frame. So if we drop down onto the daily chart then, so we're looking at this period here where price has started to sell off from that double top. If we drop down onto the daily time frame, we can see that as price sells off from that level, so again, that was our resistance level, as price is selling off from that double top, one of the first things that we notice is that price breaks through a key bullish trend line. So you can see again that we have this bullish trend line collected from this low to a secondary low. Price sells off from that big bearish reversal candlestick on the weekly, and we actually break down through that rising trend line. So hopefully from the trend line session that those of you were in, you'll remember that once we identify a break in a trend line, we can then monitor price looking for a retest of the trend lines, because broken trend lines, once retested, tend to hold. So where a bullish trend line is broken and price retests it, it tends to act as resistance, and where a bearish trend line is broken and price retests it, it tends to act as support. So these can often be great trade locations. So we've identified the break of this bullish trend line. You can see from this point here that price retraces higher and we trade back up to retest the trend line. And again, we look to identify confluence by adding in a second technical element. And so pulling in our Fibonacci tool, which is always a fantastic technical tool to use when looking to establish confluence, we can see that the 38.2% level lines up nicely with where price retests that trend line. So you can see that we drove all the way up, retested the broken trend line, pierced that 38.2% level, but then reversed and closed back beneath it. So this gives us a really good bearish signal. Remember, we've identified a big double top on the weekly time frame. We've identified that big bearish candlestick on the weekly time frame. And now dropping down onto the daily, you can see that we've got a sell-off through a bullish trend line. We've retested it, and we're also testing a key Fibonacci retracement level. So the presence of this bearish setup on the daily time frame in the context of what is going on in the higher time frames gives us confluence between these two charts to enter our bearish trade. So this is a really great example of where you can start to drill down through different time frames to identify setups. And the final aspect of confluence then that we're going to look at is confluence between market fundamentals and technicals. So with this type of confluence, what we're looking to do is form a view of the market based on fundamental elements such as data releases, monetary policy, or key political events, and then find technical setups in Confluence with that view to give us an entry to the market. So here is a great example with sterling yen. So this is a chart of the sterling yen. And at this point here, so over the start of the year, the UK Brexit landscape was really starting to deteriorate, with investors beginning to fear how the UK economy would be affected by the triggering of Article 50 and the government's confirmed plans to leave the European single market. Now, at the same time, the Japanese yen was starting to strengthen because of its status as a safe haven currency, which is a currency that investors turn to protect value during times of panic. So you can see here that sterling was weakening, the Japanese yen was strengthening, and so with this fundamental environment as our backdrop, we want to look for setups to sell sterling yen, okay? So we're expecting sterling to continue to weaken. We're expecting the Japanese yen to continue to benefit from risk aversion and its safe haven status, and so we're looking to find selling opportunities. So looking first of all at the weekly chart then, the first thing we can identify here is this big bearish engulfing candle, okay? So this is a classic bearish reversal candle. This shows us that sellers have completely overwhelmed buyers and reversed sentiment. So you can see off the lows we had two big bullish candles in a row showing that buyers were in control. However, at this point, sentiment was completely reversed and sellers drove price all the way down to close below the low of that second bullish candle. So we have the presence of a big bearish reversal candle here. So this candle supports the view that we hold fundamentally, which is that sterling is going to weaken against the Japanese yen. And so what we're looking for then is a break of this support level to confirm Confluence and enter our trade. So if we drop down onto the daily time frame, this was the low that was formed after the bearish engulfing candle. You can see that we had a short retrace higher, and then at the point which we broke down below that support level, we can go ahead and enter the sterling yen as a sell trade, as a classic breakout trade. Okay, so we've formed a fundamental view of the market. We've assessed the economics behind sterling and behind the Japanese yen, and we've concluded that we expect sterling to weaken against the Japanese yen. We then looked at the weekly time frame to identify a big bearish reversal candle which supports this idea, and we've then dropped down onto the daily time frame. We've identified the presence of a key support level in the market, and then at the point at which price breaks down through that level, we can go ahead and get short because we have confluence between our technical setup and our fundamental view of the market. Okay, everyone, well, I hope that you've enjoyed that session and found it useful, and I hope that you're able to clearly follow along with the processes and methods that I've outlined. And again, really to reiterate, this is a mindset and a methodical approach that you can use and apply to the market over and over again to identify key entry locations. So you're simply looking to identify the presence of different technical elements in the market to strengthen your bias for taking the trade. And remember, just to keep it simple, so first of all, looking to identify one technical element which is of interest. It could be a level of support and resistance, a key Fibonacci level, or a trend line. You're then looking to monitor price as it moves into that level, identify confluence with other technical elements to bolster your bias, and then, as I say, you can either look to use confluence with price action to take your trade, or if you're a more aggressive trader, simply look to trade the level. But as we talked about during the session, the beauty of using price action confluence to confirm your trading bias is that you'll often find that it helps you avoid many of the unnecessary losing trades which you can suffer if you're just trading blindly at the level. So again, I hope you found that useful and you're looking forward to applying these concepts to the market. And just before we wrap up, are there any questions I can answer for anyone? Yeah, this is recorded, Tim, so you'll get the recording of this, no problem. Great. Well, look, thanks for the feedback, and I'm pleased that you've all enjoyed the session and found it useful, and I'll catch you all again next time. In the meantime, best of luck with your trading and take care, everyone. Thanks, guys. Cheers.